Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk.
Yeah.
Today we're looking at Ondas Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, usually when we look at a stock that's up, 500 or 600% in a single year, my alarm bells start ringing. I start thinking bubble, or hype or pump and dump. But we're looking at Ondas today, and the deeper we dig, the more it feels like we're looking at a completely different company than the one that existed 12 months ago.
That is the perfect way to frame it.
Yeah.
I mean, if you knew Ondas back in 2023 or 2024, you probably just filed them away as a niche player.
Right.
They did private wireless networks for railroads. It was boring, steady, unsexy. If you look at them today, February 1st, 2026, that company is effectively gone. They've morphed into a volatility machine, sure, but also into a serious defense and autonomy contender.
And that word transformation, it gets thrown around in investor decks all the time. Usually it just means they change the logo and, fire the marketing team. But here we're seeing numbers that actually back up the narrative.
Yeah.
Let's start with the financials, because frankly, I had to reread the print when I saw the growth stats.
You and the rest of the market. The velocity of the change is what's catching people off guard. So let's look at the third quarter of 2025. They brought in $10.1 million in revenue.
Okay.
Now, for a small cap, that's a decent number. But the context is the percentage. That was a 580% increase year over year.
Nearly 600% growth. That is massive.
Right.
But let me play the skeptic for a second.
Go for it.
When you see percentage growth that high, usually it's because the denominator, the previous year's number, was tiny. Is this just the law of small numbers making them look good?
That's a fair critique, and yes, coming off a small base definitely helps. But you can't fake the acceleration forward. They just released preliminary numbers for the fourth quarter of 2025.
Oh.
They're guiding for revenue between $27 and $29 million.
Wait, hold on. They did $10 million in Q3, and they're projecting almost $30 million for Q4. That's tripling revenue sequentially.
Exactly.
Yeah.
And that preliminary number, it beats their own internal targets by over 50%. Companies rarely miss their own guidance that badly in a good way unless something fundamental has shifted in demand.
Okay, smashing internal guidance by 50% is significant. That implies they're delivering products faster than even they thought they could.
Precisely. And if you zoom out to the full year of 2025, they're landing right around $50 million total revenue. But the reason the stock is moving, the reason we're talking about it today, it isn't really 2025.
The market's forward-looking.
It's always forward-looking.
Yeah.
It's about the guidance they dropped at their investor day back in mid-January regarding 2026.
Right. That was the headline grabber. What are they promising for this year?
They raised the target range to between $170 and $180 million. Pause on that. Let's just sit with that math for a second. They did $50 million last year. They want to do $180 this year. That's a massive ramp. We're talking about tripling the size of the business in 12 months. Where's that actually coming from? You can't squeeze that much juice out of railroad wireless networks.
You can't. And they aren't trying to. The engine here is the division they call OAS Ondas Autonomous Systems. This is the pivot. This is the Drone Defense and Autonomy Division. That's where the oxygen is, and that's where the money is flowing.
So they realized the railroad business was steady but slow, and the war business, unfortunately for the world but fortunately for the balance sheet, is booming. But pivots like this are expensive.
Very.
You don't just decide to build military-grade autonomy platforms without burning cash.
Yeah.
And that brings us to the news that probably gave some retail investors a heart attack.
The financing.
The billion-dollar elephant in the room.
Yeah, right. I saw the headline, $1 billion registered direct offering. My immediate reaction as a shareholder would be panic, dilution. I'm thinking my slice of the pie just got cut into confetti. Why does a company doing $50 million in revenue need $1 billion?
It's a natural reaction. Usually when a small company raises cash, it's a survival raise.
Right, they're running out of money.
They can't pay the electric bill, so they print shares to stay alive. That's toxic dilution.
Yeah.
This is something different. You have to look at the uses of cash section of the filing.
So they aren't using it to pay off credit cards?
No. Post-offering, Ondas now sits on a pro forma cash balance exceeding $1.5 billion.
$1.5 billion. That is a fortress balance sheet. Honestly, that's bigger than the market cap of most of the companies they compete with.
It is.
It puts them in a completely different weight class.
Precisely. This is a dominance raise. They explicitly stated the funds are for corporate development. In plain English, they're going hunting. They're building a war chest to go out and acquire other companies.
So roll-up strategy?
Yeah. Exactly. They have a pipeline of over 20 potential acquisition targets, and they estimate these targets could add another $500 million in revenue.
Wow.
So when the big institutional investors, the smart money, saw this deal, they didn't see it as, oh no, my shares are worth less. They saw it as, oh, they're buying the fuel to become a billion-dollar revenue company.
That explains why the stock didn't collapse on the news. The institutions swallowed that deal because they believe the return on that cash, the companies they buy, will generate more value than the dilution costs them.
That's the bet. It signals incredibly high conviction. You don't hand a company $1 billion unless you trust the management team to deploy it effectively. It's basically a blank check for aggressive expansion.
Okay, so they have the money and they have the ambition. But let's look at the product. We mentioned OAS and defense. But what are we actually talking about here? If I'm the Department of Defense or a major logistics firm, what am I buying from Ondas? Is it just a drone with a camera on it?
No, and that's a crucial distinction. I mean, if you're just selling a drone with a camera, you're a commodity. You're competing with toys.
Right.
Ondas is selling systems. They call it drone in a box.
Okay, explain that concept. Drone in a box. It sounds like a fast food meal, but I assume it's a bit more high-tech.
Think of it as a security guard or a patrol officer that never sleeps, never eats, and lives in a weatherproof crate. The system is called Optimus. It's an automated docking station.
Okay.
The drone launches itself, flies a pre-programmed mission, maybe checking an oil pipeline, patrolling a border, or monitoring a perimeter, and then it lands itself back in the box.
And the human is where?
Nowhere near it.
Yeah.
That's the point. The box swaps the battery or recharges the drone automatically using a robotic arm inside the crate. It is fully FAA certified for automated flight.
So you could have one person monitoring multiple drones from a central location.
Exactly. You can have one operator sitting in a control room in Nevada monitoring 20 of these boxes spread across the border in Texas. It changes the economics of surveillance entirely because you remove the pilot's salary from the hourly cost of operation.
I see. So you're not paying a pilot for every single drone. You're paying for a system that runs itself. That's the moat. It's autonomy, not just flight.
That's the operational moat. But they also have a kinetic side to the business now with the Iron Drone Raider.
Kinetic is defense speak for it hits things, right?
Essentially, yes.
Yeah.
In military terms, non-kinetic might be jamming a signal. Kinetic means physical interception. The Iron Drone Raider is a drone hunter. It's designed to intercept and disable hostile drones.
Which, given modern warfare in places like Ukraine or the Middle East, is probably the highest demand product category on Earth right now.
It absolutely is. And then on the ground, they have Roboteam.
Roboteam.
These are unmanned ground vehicles, UGVs. So think of them as small tactical robot tanks or mules that can carry gear, scout ahead of soldiers, or defuse bombs.
So they have the air covered with Optimus, the counter-air covered with Iron Drone, and the ground covered with Roboteam. It's a full ecosystem of autonomy.
It is. Yeah. And this brings us to the biggest tailwind they have right now. You'll hear this term a lot in 2026. Blue UAS.
I keep seeing that in the report. Blue UAS. It sounds like a certification badge. Why does it matter to an investor?
It matters because of geopolitics. For the last decade, the drone market was dominated by DJI, a Chinese company.
Right, they were everywhere.
They made cheap, great drones. But the U.S. government realized that having Chinese-made sensors flying over military bases or critical infrastructure was a massive national security risk.
Data exfiltration, the fear that the drone is phoning home to Beijing.
Exactly. So the National Defense Authorization Act, the NDAA, effectively banned Chinese technology from the supply chain for defense contracts. Blue UAS is the cleared list. It means your tech stack is secure, certified, and compliant with U.S. policy.
So if you are the U.S. Army or even a police department using federal grants, you literally cannot buy the cheap Chinese option anymore. You have to buy Blue.
Precisely. It creates a walled garden where Ondas is one of the few players allowed to play. And we're seeing the proof. They recently announced a $14.3 million order for Optimus systems from a specific defense customer.
And that's a key validation. It's not just a trial program anymore. That's a signed check for deployment.
And the backlog confirms it. As of December 31st, 2025, their backlog surged 180% to $65.3 million.
Backlog is my favorite metric for growth stocks. Revenue looks at the past, backlog looks at the future. A 180% jump says the sales team is closing deals faster than they can build them.
Right.
That's a good problem to have.
It is. And the stock market, being the forward-looking machine it is, has noticed. Let's talk about the chart, because the technicals here are screaming.
They really are. The stock is up roughly 500 to 600% over the last 12 months. Even just starting 2026, it's up around 28%. It recently hit 4-year highs. Now, when I see a vertical chart like that, I usually worry I missed the boat. Do you see strength there or exhaustion?
Technically, it looks incredibly constructive. Analysts are pointing out a golden cross.
Let's break that down for the listeners who aren't technical analysts. What is a golden cross?
It's a momentum signal. It happens when the short-term moving average, the 50-day average price, crosses above the long-term average, the 200-day.
Okay.
It tells you that the recent price action is strong enough to pull the long-term trend upward. It's often seen as the start of a long-term bull market for the stock.
Okay, so the trend is your friend here. And I've heard mention of a cup and handle pattern as well.
Yes. A cup and handle is a classic continuation pattern. So imagine the stock goes up, then sells off a bit to form a U shape.
Yeah.
That's the cup. Then it drifts down slightly again. That's the handle. That handle is usually just weak hands taking profit. Once it breaks out of that handle, it typically shoots up. It suggests the stock is building energy for another leg higher.
So the technicians are happy. What about the fundamental analysts, the guys in suits at the banks? If the stock is already up 600%, surely they are downgrading it.
Surprisingly, no. The consensus from firms like Stifel and Lake Street is still strong buy, or moderate buy. They've actually been raising their price targets. We're seeing targets in the $12 to $19 range.
Which implies they think the market hasn't fully priced in that 2026 growth yet. But I have to point out the one thing that usually spooks me: insider selling.
Yes.
I dug into the filings and saw about $4.6 million in insider selling recently. If the future is so bright, why are the executives cashing out?
It's the classic red flag, but context is everything here. You have to ask why they're selling. In many high-growth tech companies, executives get paid in stock. When that stock vests, they have a massive tax bill to pay.
So it's an automatic sale.
Often, yeah. They sell shares automatically just to cover the taxes. It's not necessarily a lack of faith, it's a tax obligation. But the more important signal is who is on the other side of that trade.
Who's buying?
If the CEO sells, who buys? In this case, that $4 million in selling is dwarfed by institutional buying. We're seeing massive stakes being built by Vanguard, Jane Street, Renaissance Technologies.
And Claude Kings.
Right. These are the titans of Wall Street. They have algorithms and research teams deeper than anyone else. If they were worried about the insider selling, they wouldn't be piling in. They're looking at the fundamentals, the backlog, and that cash pile. They're effectively saying, we will take those shares, thank you very much.
All right, we've painted a pretty rosy picture here. Revenue is tripling, cash is practically overflowing, defense contracts are flowing because of geopolitics. But I want to be the learner for a second. My job is to protect my capital.
Sure.
What goes wrong? What is the bear case? Because nothing goes up in a straight line forever without risk.
Absolutely. And honestly, the risks here are as high as the potential rewards. This is not a savings bond. The biggest risk is simply execution.
The growing pain.
Extreme growing pains. Think about it. They want to jump from $50 million to $180 million in revenue in 1 year. And they're doing it by acquiring companies. They've bought 5 different companies recently.
And anyone who has worked in corporate America knows that merging companies is a nightmare. Different IT systems, different cultures, different sales processes.
Exactly. It's called integration risk. If they buy a drone company and the engineers quit because they hate the new management, the value of that acquisition goes to zero. If the sales teams can't figure out how to cross-sell the Optimus system with the Roboteam ground units, they miss that revenue target.
It's like trying to assemble a plane while you are already flying it at Mach 2.
That's a great analogy. And remember, they're not profitable yet.
Right. We talked about revenue, but we didn't talk about profit.
They're still losing money. Negative margins, negative EBITDA. The entire thesis is built on scale. They believe that once they get big enough, late 2026 or 2027, they'll turn profitable. But until then, they're burning cash.
And even though they have $1.5 billion in the bank, burning cash is still burning cash. If the mood in the market shifts and investors stop rewarding growth at all costs and demand profitability now, Ondas could get punished.
And let's not forget the dilution hangover. Yes, the raise was strategic, but the share count has exploded. The pie has been cut into many, many more slices. To justify the current stock price with that many shares outstanding, They have to deliver immense growth.
So the valuation is priced for perfection.
It is. If they come out and say, hey, we're only going to grow 50% this year instead of 200%, that would still be good growth for a normal company, for Ondas. The stock would likely crash.
Because the market has already paid for the triple-digit growth. Anything less is a failure.
Precisely. It's a high-wire act.
So, bringing it all together, we have a company that has pivoted hard into the hottest sector on the planet, defense autonomy. They have a war chest of $1.5 billion, which gives them immense optionality. But they have to execute a complex integration strategy perfectly to justify the valuation.
That's the summary. Ondas is a high-beta, high-growth play on global defense rearmament. It's aggressive, it's volatile, but the pieces, the cash, the tech, the backlog are all there.
It's definitely not a boring stock to watch. So for everyone listening, what are the specific dates or events they should be keeping an eye on in the next few weeks?
Watch for the audited full-year earnings coming in March. We had the preliminary numbers, but we need to see the final audit to confirm everything is clean. And, perhaps more importantly, keep an ear to the ground for that M&A pipeline.
With $1.5 billion in cash, that money is going to burn a hole in their pocket.
It is. They're going to buy something. The question is what, how much did they pay for it, and how much revenue does it bring immediately?
That will be the next big catalyst. If they announce a major acquisition that adds $50 million in revenue overnight, that changes the math all over again.
It certainly does.
Well, this has been a fascinating look at a company that is moving fast. It's a reminder that in this market, you have to look past the ticker symbol and see what the business is actually becoming. If you find our talks useful, please consider subscribe, like, and comment underneath. We love hearing your take. Do you think they can hit that 2026 target? Or is the integration risk too high? Let us know. Thanks for listening.